Well, today we have Dennis Miller of Miller's Money Forever financial newsletter with us. He's been generous enough to share some of his time for a short little interview here. And Dennis, maybe if you want to start off and just kind of tell us a little bit about yourself and your newsletter and what you've got coming up.
Well, thank you, Roger. I appreciate the opportunity. Our newsletter is Miller's Money Forever. They can find it at www.millersmoney.com. Kind of an interesting background. I was actually retired. I'm in my early 70s, and like a lot of people, got caught up with flooding of the banks in 2008. And Roger, I was old school, and that was very simple: 100 minus your age. And that was one of the rules for us to invest. So if you were 65, you'd take 100 minus 65, and you'd put 65% of your nest egg into fixed income, certificates of deposit, putting the other 35% into the market to protect you against inflation. And for the first almost decade of my retirement, it worked out pretty well. But when the Federal Reserve flooded the banks with money, the banks just took that money and paid off debt. And literally overnight, I had most every one of my CDs called in. So I opened up the computer one morning and said, "Where's this cash coming from?" And people think I'm joking, but I said to my wife, "Honey, did we win the lottery? Where'd all this cash come from?" And I realized that all my nice juicy 6 and 7% CDs had just been called in from the banks, and I couldn't replace them. 2% at the time was about the best we could get. So I was looking at a huge, huge income cut. And I went back to being a very active investor, including a lot of newsletters that I signed up for, many of them being that from Casey Research. And I kept writing David Galan, the managing editor, and I said, "You're not relating to retirees. This is the problem we've got. We've just had the rug pulled out from under us. We need help." And finally, he approached me and said, "You're 100% right. You're speaking for that age group. Would you like to take it as a challenge?" And one thing led to another, and they produced a book that I wrote called Retirement Reboot. And they also have asked me to write a newsletter, which we've been doing now for a little over a year, called Miller's Money Forever, because anybody who is either planning for retirement or already retired has just seen the game change radically. And what we're all about is trying to figure out the new rules so that we can, in fact, enjoy our retirement. So that's who I am and how I got there. And right now I'm having the time of my life.
Well, from everything I've read so far, it's not only informative, but it's even enjoyable to read. And I think you really are connecting and filling that void that was there before. Now, one thing that you mentioned is the banks calling in those CDs. This was something that most people, and I'll admit it, I didn't even realize they could do that, and it had to have caught a lot of people flat-footed. It actually, what it means is the game has, really changed for retirees, since this financial crisis. Are you seeing a level of fear among your readers of Miller's Money Forever? And if you see that fear, what advice are you giving them?
Well, the answer is absolutely. In my book, I talk about a group. I used to have a summer home in Illinois, and we called ourselves the Romeo Club, retired old men eating out. And every other Tuesday, we'd solve the problems of the world for an hour, and we could get most of them solved by the second cup of coffee. You're darn right everybody's concerned because, what we thought we could bank on was just absolutely taken away from us. But what I've realized since then is it wasn't just those of us that were retired. It was also any of the baby boomers or any of the people who were planning on retiring. Because, Roger, when you look at it, baby boomers were born from 1946 to 64. The mean age is 59 years old. Their biological clock is ticking. And the first bit of advice I give them is one that is almost like a no-brainer. Employee Benefit Research Institute published something recently that said 50% of the people in their study shows that the workers have not even tried to calculate how much they will need in retirement, let alone put a plan in place. So the first advice I'm giving them is you better sit down, whether you have a financial planner or one of those sophisticated computer programs, and figure out where you are and where you stand so that you can enjoy retirement when that day comes.
Yeah, absolutely. kind of a dream that's fading for a lot of people. But could you tell us a little bit about the difference in investment strategy for someone who's planning for their retirement versus someone who's already retired? And here we're probably talking about, say, one end of that baby boom spectrum versus the other end.
Well, that's interesting because my grandfather used to have a saying, it's the same thing, only different. And it was kind of cute, but certainly got people's attention. The underlying concept of retirement hasn't changed. Most people make it sound complicated, but Roger, when we're young, we have families, we have all kinds of obligations and trying to raise our family and save money. But in essence, what we're really doing is we're trading our time for money.
Hmm.
Then, when we get to the point where we want to retire, at least from a full time job, we're doing the reverse of that. We're trading money for time. And therefore, the process that you have on the build up side is to sit down and put a plan in place. We used to actually call it our magic number so that you could have enough money there to supplement your Social Security and supplement your other income so that once you get to that threshold where you are retired, you're now trading your time bank, which is your accumulated wealth, for time to do other things rather than work full time. So that when you get over that threshold, we have to make sure that that money does indeed last us the rest of our life. The concept is the same, it's just different steps along the way that we have to take to accumulate it and then make sure we keep enough.
Right, right. And I've seen you talking about a lot of those different steps in your newsletter as well. Now, putting yourself in a position where you can retire and enjoy that retirement, it is a process and not a one-time event. And this is what you've been saying for a long time now. A lot of folks view retirement as sitting by the pool or playing golf without a care. Is that a realistic view anymore?
No, not anymore. But the sad thing is, Roger, it used to be. Let's go back to just what I talked about with 100 minus your age. Let's say that you're traditional, you retire at 65. Uh, when I retired the first time, I could have 65% of my net worth in CDs or nice treasuries, but say fixed income product. I could put the other 35% into an S&P 500 fund, which would help keep up with inflation. And we were pretty well set for life. Go and enjoy and have a good time doing the things that you want to do. And that was the way that it would work. Well, it doesn't work that way anymore because they took that foundation out from under us that I just talked about. So let's even go back to, let's say you're 50 and you're really starting to get serious about it. If you took 50% of your net worth today as a 50-year-old and you put it into those same fixed income, the amount of interest you're going to get isn't even going to keep up with inflation. So that the other half of your portfolio, even from the get-go, has to give you double-digit returns, which is unrealistic. Now, when you move it out to 60, 65, the kind of returns that you would have to get under the old rules would almost be like you have to win the lottery. So I tell people now, if you set it, you forget it, you're going to lose it. We have to actively manage our portfolio. Roger, if you got time, I want to tell you about just one instance that has really hit home for me, how you have to stay on top of things. We saw what happened when Mr. Bernanke uttered his famous word taper, and it wasn't even that they were going to do anything. They were thinking about it, as most people will remember. And the market went bananas, gold went bananas, and then finally the Fed went out and tried to calm the markets and say, we didn't really mean it, didn't really mean it. Well, I'm sitting down with our investment team and I've said, you guys ever heard of what we call widow stocks? These are all younger people. They're really good. And I said, what do you mean? Well, they're utilities. We used to call them widow stocks. No stockbroker ever got in trouble for taking an 80-year-old widow and investing her in utilities because they have no competition. They are regulated, so they get to make a profit, and they pay nice, steady dividends. So that it was a very, very safe investment.
Right.
Maybe we ought to be looking at those. So the research team comes back, and they show me a exchange traded fund, which is a basket of utilities. It's XLU is the trading symbol. And they started by showing me the S&P 500, and they started on the 1st of May. And then I think it was the week of June 19th that Mr. Bernanke uttered his word taper, and the market came down sharply, and then it started to go back up. And then they put a second line and said, now historically, these kinds of stocks have been very, very not volatile, I guess would be the right word. And they said, now here's how it would have traded historically, and it would have just followed right along with that S&P number. But then they, to make the point with me, added a third line, which is a red line. And the red line on the 1st of May just starts going down, down, down. And on the day that Mr. Bernanke uttered his word taper, it dropped 11.2% in one day. Now, Roger, stop and think about that. If you'll take a look at it from the retiree's perspective, those were the safest stocks going. Every retiree at one time had all their nice utility stocks. But all of the money that was into the CDs, all the money that was into the treasury bonds, so many billions of dollars now have gone into those utility stocks. They are now trading like bonds and are very interest rate sensitive. And, I joked with my team. I said, Yogi Berra, the Hall of Fame baseball player, used to make these funny little remarks. And one of his funny little remarks is that restaurant is so crowded, nobody goes there anymore. And
Yeah.
I told the team, I said, it looks to me like these utility stocks are so crowded, my retirement money is not going to go there anymore either. And that's what I mean. Is just one example of how, if we're not staying on top of things, we can be in for some very rude awakenings. The market's changed, and anybody who is at any stage of the retirement process has got to take a much more active role.
Well, and I think there are a lot of people who either don't have the time, don't have the energy, or don't feel qualified. And quite honestly, some of them probably are not. And that's where I think they rely on you and your team to do a lot of that for them. And that doesn't necessarily take the responsibility off their shoulders, but it certainly gives them a leg up over someone who doesn't have anyone else to lean on.
Well, exactly. And there is a lot of very good certified financial planners out there that are very, very qualified to give individual personal investment advice. The one thing, though, that we tell all of our readers is while you may want to delegate part of that responsibility, you never want to abdicate it because that's your retirement money. And that one of the things you have to do is you have to let that advisor educate you. It's our responsibility to be educated, even though we can get some help. Because if they make a mistake, they lose a client. Okay, you may lose your entire retirement money. So you've got to stay on top of it.
Absolutely. And I've noticed you writing some excellent articles on how to choose a financial planner.
Yeah, as a matter of fact, I mentioned on our website, millersmoney.com, we have gone to many what I call subject matter experts, and we work with a gentleman named Jeff White, who's the president of one of these large firms, and he has given us some great insights as to how to sit down, how to interview them, how to make sure you're comfortable with them, because it is such an important decision. So many people now. Well, let me back up for a second. Only 3% of the population that is retiring from the private sector now has a pension. The pension plans of the private sector have just gone. And so now they're ending up with a 401k type program. So it's an awful lot to expect for somebody to work hard, pay their taxes, get to the end of the line. And I mean, I've got friends that might have 500,000, $1 million in a 401k program. So they have their retirement party. They get this nice lump sum payout of their 401k and say, now, good luck. You better make that money last for the rest of your life. And that regardless of how we made our money, once we get to that point, we're now personal pension fund managers. And we better figure it out.
Oh, that's absolutely right. And that's kind of a great segue into your free webinar you have coming up on September 5th called America's Broken Promise, Strategies for Retirement Worth Living. Why did you feel the need to put this webinar together? How do you feel the promise of a secure retirement has been broken? And what does that mean to the boomers who are either retired or facing retirement soon?
Well, that's a loaded question. For the sake of our listeners, they can go to www.americasbrokenpromise.org. The webinar is free. It's going to be on September 5th. I put it together for several reasons. The first reason was that I think a lot of people still aren't getting the message. You know, when I talked about the 58% of the workers who've done nothing, we brought in David Walker, who is the former controller of the currency, John Stossel from Fox Business News, and these guys lay out a really, really powerful case that the cupboard is bare and that those promises that a lot of us are relying on, whether it's Social Security or the poor folks up in Detroit who just filed for bankruptcy, the money's not going to be there. And as a result, we're going to have to sit down and develop some strategies where we're going to be successful regardless of those promises being broken. And, you know, one of the things that I think most of us have made the mistake, I know I must confess that I did. I don't know, Roger, I'm sure you've probably sat down and seen these programs that these certified financial planners have where they take your age and how much your nest egg is and how much you save, and then they project it so that here's how much money you have to have when you retire. And they've got these really sophisticated programs, okay?
Right.
Now, every one of those programs are based on assumptions. For example, we'll assume inflation was only 2% because that's what it's been historically. Or we'll assume we can make a 7% compounded return on your money. And one of the things that I tell folks is those are assumptions. We got to make sure we make those numbers. But one of the reasons I really want to drive this home with this webinar is we can't make the biggest mistake of ignoring the biggest assumption of all. And that is that number that we end up with. As I said, we used to call that our magic number. That was designed to throw off income to supplement our Social Security, to supplement our other retirement income. But the assumption is that that money will be there when we get to the end of the line, that that program is not going to change. Now, in my lifetime, I have seen changes in Social Security. They made part of it taxable in the 1980s. They moved back the retirement date. And to sit there and go through all the retirement planning process and assume that that fixed income that we're counting on from the government is going to be there in the same form it exists today is a tremendous, tremendous mistake because it's not going to be there. The government doesn't have the money.
Yeah, and that is a very sad fact, and perhaps even sadder that so many people really made very few, if any, preparations for themselves aside from that. Well, I tell you, I am very much looking forward to that webinar coming up. You've mentioned some people that are going to be there. There's some pretty heavy hitters. John Stossel is a guy that I've watched for years and years, and he was one of the most trustworthy people in the news media. And that's there's not a lot of them, I'm afraid, type of news format that he came from. Let's put it that way.
Well, I want to talk about John for just a minute because he's written a book called No, They Can't: Why Government Fails and People Succeed. And what I've come to realize is not everybody succeeds, but I also believe I've seen friends that work for the airlines that retired, the airlines went bankrupt. I had one friend took an $88,000 reduction in his pension. I mean, you want to talk about broken promises. I have many others that have taken reductions, but not to that degree. Yet the ones that take responsibility for themselves and recognize it's their problem and put together a plan in place have still managed to retire comfortably. So, you know, I don't want people to get discouraged. It can be done, but the sooner you start the process, the better off you're going to be.
Absolutely, absolutely. Well, Dennis, I sure appreciate you taking so much time to be with us today, and we are going to be looking forward to that webinar on September the 5th. And in the meantime, I'm going to have a link in the description of this recording that people can click on that, get signed up for the webinar, links to millersmoney.com, and the special website set up for the webinar, americasbrokenpromise.org. Is there anything else you'd like to say just in closing?
No, I really appreciate it, and I'm looking forward to the webinar. I think there's a lot of people out there right now that are looking for help, and it's folks like you that are going out and providing the help. The help is there. I think our biggest challenge is to get people to realize just how serious the situation is. So thank you for having me.
Well, thank you again, and we will see you on September the 5th. There's a link in the description of this video. Click on that and you'll go to our website, InvestLetters.com, where you'll get more information on Dennis's show, America's Broken Promise, Strategies for a Retirement Worth Living. Thanks for listening today. We will see you there.